Let me ask you something genuinely. If I told you the US government created a legal way for people over 50 to put more money into retirement accounts while paying less in taxes, money that compounds and grows completely untouched for years, how many of you would use it? Probably most of you. So here is the part that drives me absolutely crazy. Most people over 50 are not using it, not because they do not qualify, not because it is complicated, just because nobody clearly explained what it is, how much it is worth, and exactly how to turn it on. Today that changes. I am going to walk you through everything you need to know about catch-up contributions in 2026, including a brand new rule that took effect this January that nobody is talking about, but that could change how you handle this strategy completely. By the time this video ends, you are going to know more about this topic than most people who have been working with financial advisors for years. So let's start from the beginning. What exactly is a catch-up contribution? When you contribute money to a retirement account, like a 401k or an IRA, the IRS puts a cap on how much you can put in each year. Those limits exist for everyone. But Congress built a specific exception into the tax code for people aged 50 and older, which is the recognition that a lot of Americans spend their 30s and 40s paying mortgages, raising kids, and dealing with life. And they simply could not save as aggressively for retirement during those years as they would have liked. So the government created catch-up contributions, extra money above the standard limit, that only people 50 and older are legally allowed to put into their retirement accounts every single year. And in 2026, those limits are the highest they have ever been. Here are the actual 2026 numbers straight from the IRS. The standard contribution limit for a 401k, 403b, 457 plan, or the federal thrift savings plan is $20,500 this year, up from $20,350 in 2025. But if you are 50 or older, you can add a catch-up contribution of $8,000 on top of that. That brings your total annual 401k contribution potential to $32,500 per year. Now, here is where it gets even more interesting. If you happen to be between the ages of 60 and 63 specifically, not 64, not 59, specifically 60 to 63, the Secure Act 2.0 created what is called a super catch-up contribution. Instead of the standard $8,000 catch-up, you can contribute $11,150 extra, bringing your total 401k contribution to $35,750 in a single year. The government created a bigger window specifically for this 4-year age bracket to accelerate savings right before typical retirement age. If you are in that window right now in 2026, that opportunity is sitting there waiting, and every month you do not use it is a month you cannot get back. Drop a comment right now and tell me, were you already using catch-up contributions, or is this the first time you are hearing about this? I genuinely want to know because I think the answer might surprise a lot of people in this community. Now let's add the IRA numbers on top of that. For 2026, the standard IRA contribution limit, whether traditional or Roth, is $7,500. And for people 50 and older, there is now a catch-up contribution of $1 to $100, bringing your total IRA contribution limit to $8,600 annually. And here is something new that most people have not heard. Starting in 2026, that $1,100 IRA catch-up amount is now indexed to inflation. For decades, that catch-up sat at a flat $1,000 and never moved. Now it adjusts automatically each year to keep up with the cost of living. It is a small number in isolation, but the principle matters. The government is now explicitly building inflation protection into the catch-up system. So if you have both a 401k through your employer and a separate IRA, you can potentially put away $30,500 plus $8,600. That is over $41,000 per year in tax-advantaged retirement accounts if you are 50 or older. And if you are in that 60 to 63 super catch-up window, the combined potential rises to over $44,000 annually. Now, let's talk about what this actually means in real tax savings, because I want you to feel this in dollars and cents, not just theory. Let's say you are 55, you have a decent income, and you are in the 22% federal tax bracket. Every dollar you contribute to a traditional pre-tax 401k reduces your taxable income by that same dollar. So if you max out the full $32,500 catch-up eligible contribution for 2026, you are reducing your taxable income by $32,500. At the 22% bracket, that is $7,150 in federal taxes you simply do not pay this year. That money, instead of going to the IRS, goes directly into your retirement account to grow. If you are in the 24% bracket, that same move saves you $7,800 in federal taxes in a single year. And depending on your state, there are often state income tax savings on top of that. Catch-up contributions are not just a savings tool. They are a tax reduction strategy hiding in plain sight that most people 50 and older are completely ignoring. If you are not subscribed to Wise Dude yet, hit that subscribe button right now. I break down exactly this kind of real practical financial strategy every single week in plain language, not textbook stuff. Actionable information you can actually use. Subscribe and turn on the bell so you never miss it. Now I need to tell you about the new rule that took effect on January 1st, 2026, because this one catches a lot of people off guard. And if you are a higher earner, you absolutely need to know about it. Starting this year, if your FICA wages in 2025 exceeded $150,000, every single catch-up contribution you make to your employer-sponsored plan, your 401k, your 403b, your 457, must now go into the Roth side of the account, not the pre-tax side. This is a major change. It means if you are a higher earner, you lose the immediate upfront tax deduction on your catch-up contributions. You will contribute after-tax dollars instead of pre-tax dollars. That sounds like bad news on the surface, but there is a silver lining that is genuinely worth understanding. Roth contributions grow completely tax-free, and you owe zero taxes on qualified withdrawals in retirement. So instead of saving on taxes today, you are eliminating taxes on that money forever. Given where tax rates could go in the future, and given that Social Security required minimum distributions and other retirement income can push retirees into higher tax brackets than they expect, having a pile of tax-free Roth money is actually a powerful position to be in. But here is the critical warning that comes with this new rule. If you earn over $150,000 and your 401k plan does not currently offer a Roth contribution option, your plan must add one for you to make catch-up contributions at all in 2026. Some employers have not done this yet. If your plan lacks a Roth option and your income exceeds the threshold, you could be completely locked out of making any catch-up contributions this year. Not just the Roth kind, all of them. This is not hypothetical. It is already affecting people. The single most important thing you can do today if you are a higher earner is call your HR department or benefits administrator, confirm your plan offers Roth contributions, and get your catch-up contribution settings updated immediately. Like this video right now, if this information is useful to you. I put a lot of work into making sure every piece of data here is current and accurate, and it genuinely helps to know it is landing for people who need it. Now let's quickly cover the other account types, because catch-up contributions apply beyond just the standard 401k. If your employer offers a simple IRA, which is common at small businesses, the standard contribution limit in 2026 is $17,000, and the catch-up for people 50 and older is $4,000, up from $3,500 last year. If you're between 60 and 63, that same super catch-up window applies with a limit of $5,250. And if you are self-employed or own a small business, you have access to SEP IRA contributions with a 2026 limit that has jumped to $72,000, which is a completely separate and enormous opportunity worth discussing with a financial advisor if you earn any self-employment income at all. One more account worth mentioning in this conversation is the health savings account. If you are on a high deductible health plan and you are 55 or older, you can contribute an extra $1,000 per year as an HSA catch-up on top of the standard $4,300 individual or $8,550 family limits for 2026. The HSA is actually the most tax-efficient account available to Americans. Contributions go in pre-tax, grow tax-free, and come out tax-free for medical expenses. In retirement, healthcare is typically your biggest unplanned cost. Building a catch-up boosted HSA now is one of the smartest moves available to anyone over 55 who qualifies. Share this video with someone over 50 who you think does not know about this. Seriously, because the gap between people who know about catch-up contributions and actually use them and people who have never heard of them can easily translate to $100,000 to $200,000 in additional retirement savings over a decade. That is not an exaggeration. It is just the math of consistent additional contributions compounding over time. One share from you could make that difference for someone in your life. Here is the complete picture. Catch-up contributions are one of the most legitimate and powerful tax advantages the US government offers to people over 50. In 2026, you can contribute $3,250 into a 401k if you are 50 or older, or $35 to $750 if you are between 60 and 63. You can add another $600 into an IRA. The tax savings on these contributions at common tax brackets range from $7,000 to nearly $10,000 per year in federal taxes alone. A brand new rule this year requires higher earners above $150,000 to make catch-up contributions on a Roth basis, which comes with its own long-term advantages, but requires your plan to offer a Roth option. And if you have a simple IRA, SEP, IRA, or HSA, catch-up opportunities exist in all of those as well. The first step is the simplest one. Log into your retirement account tonight or call HR tomorrow morning and find out what your current contribution level is and what the catch-up limit is for your specific plan. Then close the gap. Because this is not a complicated strategy. It is just a switch that needs to be flipped. And now you know exactly where it is.